Well, we are going to move on here and look at the Magnificent 7 ETF. The shares are down over the last 5 days, with the Mag 7 shedding over $140 billion in market cap on Monday. That dragged the S&P 500 over 0.3% lower to the downside. Now, this ahead of Nvidia's highly anticipated earnings report out Wednesday after the market close. Here to discuss what's next for the sector, we've got Seema Shah, Principal Asset Management Chief Global Strategist. Seema, it's always great to have you on, so thank you for making the time here. I just want to talk about what we are seeing in terms of this market rotation at the moment. Earlier, I was mentioning that the Russell was sort of the outperformer yesterday. Now today, the Russell taking a bit of the foot off the gas here. Is this rotation that we're seeing right now a healthy one, or is that just the label that folks who come on our show are putting on it to make sure that we maintain some upside momentum here?
Thanks for having me on. So I think what you have been seeing is that in the latest earnings season, that really strong earnings performance that we had seen very much isolated to that big tech group has now started to broaden out to other sectors. That is a reflection of pretty healthy, solid economic growth. So it is. I think it's a healthy improvement in the market. You never really want it to be entirely dependent on a handful of companies, which can always, potentially disappoint. So this is good news. The thing that we need to watch from here, though, is with the economy slowing down somewhat, can you continue to expect to see some of these other sectors, which have done well in Q2, to actually continue to deliver good performance through the rest of the year into 2025? And I think the jury is probably still out on that one.
What are those sectors?
So it's anything outside of the big tech, the large consumer discretionaries. So some of the areas that we'd be watching out for at this point is, of course, financials. Some of the companies which do well in a rate cutting environment, such as real estate, utilities. So there's different segments which will be buffeted by the various forces. What we generally want to see, though, for a healthy equity market is that you're seeing performance which is spread out across a number of sectors rather than just being driven, as I said, by the Magnificent Seven or a couple more tech companies.
Sticking with tech, I'm just curious, are lower rates to come from the Fed as big of a catalyst for big tech as they were prior to 2022, when we were in this free money market and you could have the likes of WeWork raking in cash to be able to do whatever they wanted with because cash was free? Are we going to see the same movement in tech moving forward, even though we've had this shift to the idea that tech can still be a driver of returns, even with cash being a little bit more expensive?
Yeah, it's a good question, because I think the environment for tech has certainly changed. As you said before, it would be when rates are going down, there would probably be some outperformance. I think things have changed a little bit, sorry, the other way around, but I think that things have changed a little bit where the tech sector is somewhat macro agnostic. What people are investing in tech for is the productivity gains, knowing that it's sort of at the forefront, I guess, of productivity and growth for the economy. So what we would actually expect is that there could be certainly some headwinds as you go through the coming months and growth starts to slow down. But at the same time, these companies are strong enough, are probably the strongest ones, to be able to pivot, rely on their very, very strong balance sheets, the fact that they're very cash rich. They don't come across the same kind of problems that a number of the smaller companies would. So actually, this is more about, can they really deliver on the sky high earnings that investors have put on them, rather than actually, to my mind, what is going on in the macro backdrop.
Seema, I loved one of your write-ups, and I was upset that it was about the UK economy, because I wish that we could say that it was, the US economy and give the US economy some type of kind of cool, viral, sensational kind of annexation to it. You said the UK economy is having a brat summer. And right now, demure is in focus. I don't know if we want to go there or not, but all of these things considered, how would you define the U.S. economy and even as we're kind of looking across and waiting for consumer confidence to come out at 10, to get a better sense of exactly how consumers really feel right now?
Yeah, I love that term. And I think I've had a couple of people say, actually, that does remind them of the US as well. There is a bit of a difference, though. The UK has really struggled over the couple of quarters. And now it seems like it's having a bit of a resurgence, and it's getting through what is increasingly looking like a challenging time almost for the global economy. For the US, it's a little bit different, because you have seen that growth has been decelerating since it peaked in the second half of last year. Now, we're not very negative. We're not anticipating recession, for example, but we do think that slowdown is building some momentum And for consumers in particular, of course, you have to watch that because that is a circuit breaker. If they can retain their strength, then maybe the labor market weakness that we've been seeing come through can actually come to a halt and almost stop there. So the consumer confidence numbers, very important. Watching how consumer discretionaries are doing well. Just the general behavior of making sure that any consumer strains that you're seeing come through in the US economy is really isolated to some of the lower income household rather than being spread out to the medium and higher income households. Those are the key things that we'd be watching.
Seema, at what point does that sort of K-shaped recovery that you're describing become a bigger problem for the Federal Reserve, given that it is a little bit harder to see the challenges of the lower income households in the top line numbers in the data?
Yeah, it's a great question. So typically for the US economy, the medium to higher income households account for about 60 to 70% of consumer spending. So what that means is if those two income groups can continue to spend pretty well, and assuming that the low income household find they're feeling some strain, but they're not really falling off a cliff, those medium to higher income households can really carry the US economy. Things start to go wrong when layoffs become more widespread because whatever happens to the lower income household from a layoff perspective does eventually spread throughout the economy. So it's not a great situation, of course, to have such a bifurcated economy, but it's really the problems start when that lower income households start to fall into the job layoff cycle, and then it does spread, and then the Fed really does have a problem on their hands.
Seema Shah, Principal Asset Management Chief Global Strategist. Great to see you, Seema. Thanks so much for the time and the insights. Appreciate it.